A bank loan is a lump sum of money that you borrow from a bank and agree to repay over a fixed period with interest. Loans are usually used for big purchases like buying a house, starting a business, or consolidating debt. They come with fixed terms, meaning you'll have a set monthly payment and a clear end date. Once you get the loan, you can't borrow more unless you apply for a new one. The main advantage of a bank loan is stability. You know exactly how much you owe, what your interest rate is, and when you'll pay it off. However, qualifying for a loan can be tough since banks require a good credit score, proof of income, and sometimes collateral like a house or car. A credit line, or line of credit, works differently. Instead of getting a lump sum, a credit line gives you access to a set amount of money that you can borrow from as needed. Think of it like a credit card. You can take out money, repay it, and borrow again up to your limit. You only pay interest on the amount you use, not the full credit limit. This makes it a flexible option for people who need ongoing access to funds, like business owners covering cash flow gaps or homeowners making home improvements over time. However, credit lines often come with variable interest rates, meaning your payments can change over time, making budgeting harder. Now, let's compare them side by side. First, structure. A bank loan gives you a fixed amount up front with structured repayments, while a credit line lets you borrow as needed up to a limit. If you prefer predictability, a bank loan is better, but if you need flexibility, a credit line is the way to go. Next, let's talk about interest rates. Bank loans usually have lower, fixed interest rates, making them more affordable in the long run. Credit lines often have higher, variable rates, meaning your borrowing costs can increase over time. If you want stable and lower interest payments, a bank loan wins. What about repayment? With a bank loan, you make fixed payments every month until the debt is fully repaid. With a credit line, you have more flexibility. You can pay off just the minimum or more whenever you want. However, if you only make small payments on a credit line, you could stay in debt for a long time. If you need discipline and a clear payoff plan, a bank loan is better. Now, let's consider accessibility. A credit line is often easier to qualify for than a bank loan, especially if it's unsecured, meaning you don't need to put up collateral. Some credit lines, like home equity lines of credit, HELOCs, do require collateral but offer higher borrowing limits. If you need quick access to funds and don't want a long approval process, a credit line is more convenient. Finally, let's talk about purpose. A bank loan is great for one-time expenses like buying a car, funding a wedding, or making a large investment. A credit line is better for ongoing needs, like covering business expenses, handling unexpected emergencies, or managing irregular income. If you have a specific expense in mind, a bank loan is best. If you want ongoing financial flexibility, a credit line is the better choice. So which one is better? If you need a large sum of money for a big purchase with a predictable repayment plan, a bank loan is the smarter choice. But if you need flexible borrowing for ongoing expenses, a credit line is the better option. The right choice depends on your financial situation and how you plan to use the funds.